Dear investors, welcome to the podcast for the month of June. This is like a half yearly end, so we'll do an asset class update this month in terms of we've seen equity markets rally, bond have also been rallying, and gold is consolidating. Amidst all this, how do you construct the portfolio? What is the outlook for each of the asset classes? Let's just discuss that. And just as a recap, if you look at this year, YTD, year to date 2023, Indian 10-year bond yields have moved lower from about 7.35% levels to 7% now. The CRISIL Composite Bond Index is up 4.2% for the year. Headline equity indices are trading near all-time high levels, touched in late 2022. Sensex and Nifty are up 3.5% and 2.8% respectively on a total return basis. Domestic gold investors are sitting on a 8.4% gains. So again, this year, despite the consolidation that we're seeing, gold is emerging as the best performing asset class, reminding you its space in your portfolio. So today we'll cover a quick update on these asset classes, discuss what's in store for them, and finally talk about what investors should be doing in the current context. Let's begin with equity markets, given we are seeing equity markets almost at all-time high levels. So if you look at the last quarter, we saw healthy earnings growth, largely because of the moderation in input prices and a reasonably strong domestic demand environment. Capital goods sector saw improvement in order books, and real estate witnessed continued positive sales traction. Autos witnessed improvement in volumes across various segments. Credit growth across banks were strong, especially retail segment. Some of the banks reported record profitability driven by low credit cost and better net interest margins. So profitability for banks is pretty good. Looking at the big picture from a macro standpoint, economy continues to benefit from fundamentally stronger balance sheet positions of the private sector, and the government supply side focused policy measures reinvigorating capex. Domestic demand indicators continuing to exhibit broad-based recovery. Government spending in the run-up to 2024 elections is expected to be a further tailwind, especially for rural economy, which has shown some signs of improvement of late. India is seeing a sharp cool-off in inflation. Current benign commodity prices put India in a comfortable position with respect to the current account deficit. If you look at the GST collections, they remain strong, coming in higher than 1.4 lakh crore for 14 consecutive months now. India's GDP grew at 6.1% in the January to March 2023 quarter, pushing the annual GDP growth rate for the last fiscal year, that is FY 22-23, to 7.2%. PMIs, which is a leading indicator for growth again, have been above the 50 mark since July 2021, telling us that the traction on growth is pretty good. So risk of a recession in the US will be on sectors reliant on exports, thus delaying the growth cycle to some extent. But if there is a shallow recession, a controlled recession in the developed world, it could be positive for India because it will bring along with it muted commodity prices, which is always good for Indian markets. Impact of El Nino conditions on Indian monsoons and market reaction to 2024 general elections will be the key variables to watch going forward. We expect domestic demand to strengthen and be the key driver of India's growth trajectory amid the external and cyclical headwinds that we're witnessing. While relative valuations remain rich, India is in a comfortable spot due to the economic upcycle it finds itself in and strong earnings growth prospects. So this period is very different from what we saw in markets from 2014-15 till 2018-19. It was not marked by earnings growth. This time around, we are witnessing strong earnings growth from companies. Investors should not be unnerved by the near-term volatility and focus on allocating prudently to equity based on their financial goals. Any sharp correction due to near-term headwinds can offer additional valuation comfort and should be used to allocate more to equities with a longer-term perspective. Coming to the fixed income markets, headline CPI, that is consumer price inflation for April, is to 4.7% year on year, owing to base effect and a broad-based moderation in commodity prices. Core CPI, which is X of food and fuel elements, decelerated below the 6% mark to 5.3% year on year in April. RBI governor announced that Monetary Policy Committee unanimously decided to keep the policy rates unchanged at 6.5%. Additionally, the committee will remain focused on withdrawal of accommodative stance. The governor also quashed any possibility of a rate reversal this year by stating that the central bank will not back off till it brings inflation down to 4%. He said the RBI will remain vigilant given the commodity prices, monsoon, and geopolitical risk to inflation. So RBI continued to retain their positive stance on the Indian economy and retain their growth projections on GDP for FY24 at 6.5%. We continue to expect the RBI Monetary Policy Committee to remain on an extended pause as it evaluates the inflation growth dynamics. Given that inflation is trending down and the rate hiking cycle is nearing its end, the probability of capital gains in the long-term bonds over the medium term has increased. Investors with over 2 to 3 years investment horizon should allocate to dynamic bond funds, which tend to benefit in this kind of interest rate environment. Investors with short-term horizons and low risk appetite should stick with liquid funds and benefit from the accrual they offer today. Coming to the gold market, gold has been trading range bound in a tight range over the last month as markets' interest rate expectations from the Fed continue to readjust based on incoming data. Weighing on gold prices was the US inflation data for April that showed prices slightly decelerated but were sticky at elevated levels. US employment data for April came in stronger than expected and was another setback for gold prices. The Fed told markets that it will take a data-dependent approach to future rate hikes during its May meeting. At its June meeting, the Fed is expected to weigh the slower than expected progress on inflation at one end, and at the other end, the resilient labor market against tightening credit conditions. With US regional banking crisis showing signs of stability now, inflation still running hot, and the debt deal coming through, the Fed may choose to raise rates in June or July, which will be negative for gold in the near term. On the other hand, if the Fed does pause in June, whether the pause will be extended or temporary will depend on whether or not prices remain stable or are on a sustained downward path. A pause would be positive for gold prices. But over the medium term, the economic headroom for the Fed to keep raising rates is limited. The chance of recession over next year held steady at 65% in the US, according to Bloomberg's survey of economists in May. The US 10 to 2-year yield curve remains inverted, which is also again a leading sign of recession. Markets are still expecting the Federal Reserve to cut rates later this year. A rate cut will be preceded by deteriorating economic conditions or financial instability, according to us, because that is where the Fed kind of reacts. And it will make the investment case for holding gold into portfolio for diversification purposes very, very strong. Investors can use the current consolidation in prices to accumulate gold and build their long-term allocations. So given what we have seen for all the three asset classes, they're showing good prospects over the medium to long term. Asset allocation weighing more towards equities and adequately diversified into gold for risk mitigation and debt for stability will be a good strategy to adopt at this juncture. So it kind of goes into our recommended asset allocation of 12-80-20, where you need some of the emergency corpus if something were to go wrong, a higher allocation like 80% into equities and about a 20% into gold. So I think that suits very well even at this kind of market scenario that we are witnessing. So with that, I wish you happy investing. Asset allocation is the key to investing. Please remember that. and I'll come back next month with some interesting topics. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.